Time value of money is an important topic in both finance and accounting because of one very simple concept. A dollar received today is generally more valuable than that same dollar received at some time in the future. This is true for a few different reasons, and we'll discuss them in a bit, but it's also something that just intuitively makes sense. Imagine a genie appeared and offered you a choice. You can accept $10,000 today, or they'll come back in 1 year and give you $10,000 then. Of course, you would choose $10,000 today. It would make no sense to wait 1 year just to receive the same amount of cash. Intuitively, you correctly perceive the first option as the more valuable of the two. But now imagine that same genie appears and offers you the same two choices, with one small difference. You can accept $10,000 today, or they'll come back in 1 year and give you $11,000 then. Well, now the decision becomes more interesting. On the one hand, $11,000 is obviously more than $10,000. But it comes with an important caveat. You have to wait a year to receive it. And the moment we introduce that delay, a very natural question follows. What will I have to give up by waiting? And this is the idea of opportunity cost, which is the value of the next best alternative you give up when making a decision. I know when you come across decisions like this in your life, you don't stop and think about the formal definition of opportunity cost. But intuitively, you do make decisions like this nearly every day. And it's the correct way to think about this question, because the extra $1,000 isn't the only consideration. You also have to consider what you could do with that $10,000 in the meantime, and whether any of those alternatives would leave you better off. So you might ask yourself whether you could invest that $10,000 today and earn more than $1,000 over the next year. You might think about inflation and whether prices will rise between now and then. Or maybe you have a loan outstanding, and paying down $10,000 today would save you more than $1,000 in interest over the next year. All of those considerations are part of the same underlying question. Not only are we interested in the best use of the money, we're interested in the best use of the money over time. And this is the core concept on which this series is based. Be it in your own personal finances, as part of a corporate finance team, and certainly at times in accounting, when analyzing the flow of cash, it's not only the dollar amount that matters. The timing of when you receive or pay those cash flows is also very important. Generally speaking, a dollar you receive today is more valuable than a dollar you receive tomorrow. But let's try to move beyond intuition and figure out exactly why this is the case. A $20 bill is a $20 bill, and it will still be a $20 bill in the future. So why exactly is that $20 more valuable to you today than in the future? Well, there are many different economic forces at play here, and all of them are impacted by and influence the others. So let's look at a couple of the important ones. The first is inflation. Something most, if not all of us are familiar with. Inflation is the phenomenon where the price of goods and services increase over time, which means that $100 today can buy a larger basket of goods than $100 in the future, because the prices of those goods rise over time. The consensus among economists and central bankers is that an annual inflation rate of right around 2% is the sweet spot for a healthy economy. And indeed, though their measurement process may differ slightly, most central banks set an inflation target in that range. So even in a stable and advanced economy, if all else were equal and no other factors were considered in our decision making, inflation alone would cause a dollar today to be more valuable than a dollar in the future. But it's certainly far from the only consideration. The idea of risk and uncertainty plays an important role in the time value of money as well. Let's go back to our example where a genie offers us $10,000 today or $11,000 a year from now. It may very well make sense to choose the $11,000 a year from now. But we are taking a risk that the genie doesn't reappear as they said they would. And we need to decide whether $1,000 is an acceptable amount to compensate for that risk. Now, unfortunately, genies offering money don't exist. But in the real world, opportunities to delay spending today in exchange for a potential return in the future are everywhere. You could invest it in treasury bonds, corporate bonds, stocks, and many other financial instruments. With any of those, you would expect your money to grow over time. But you also accept some level of risk. And generally speaking, the higher the risk, the higher potential return you would require. Which all brings us back to our core concept for this series. Time has value. The longer we need to wait for the genie to reappear, the more risk we accept, and the more payoff we'd require. We might agree to forego $10,000 today to receive $11,000 1 year from now. But if instead our genie offered to reappear with $11,000 10 years from now, that offer becomes far less compelling. Inflation alone would likely erode all of that $1,000 and then some. And the uncertainty grows the longer we wait. Again, time has value. And as we mentioned at the beginning of our discussion, this concept appears in many different financial applications. If we focus on accounting specifically, think about all the areas we interact with a series of cash flows over time. This is by no means exhaustive, but leases, pensions, bonds, notes receivable, even product warranties represent a series of cash flows over time. And that's before we even step into the world of finance, where time value of money is one of the foundational concepts behind capital allocation and investment decisions. So as we move forward in this series, keep that key idea in mind. Time has value. And in the next episode, we'll begin to cover the concrete mechanics that go into time value of money analysis, beginning with the different types of interest.